$10,000. It's a nice round number, a solid starting point. But here's the question almost nobody asks correctly. How much actual cash will that $10,000 put in your pocket every single year? And I'm not talking about some theoretical number that sounds good on paper. I mean cash distributions that can vary month to month based on fund payouts and market conditions. Most people guess wrong, way wrong, and the mistake they make could cost them hundreds of dollars annually without them ever realizing it. See, the dividend investing world has a dirty little secret. The ETFs that look safest on the surface often pay you the least. Meanwhile, the ones flashing double-digit yields might be quietly eating your principal while you sleep. And somewhere in between sits a sweet spot that almost nobody talks about because it doesn't fit neatly into either camp. Today, I'm breaking down exactly what $10,000 produces across 3 completely different dividend income strategies. We're going with real numbers, real yields, and real trade-offs. By the end, you'll know which approach actually matches your goals, and which one might be sabotaging your wealth building without you even knowing it. Let's start with the obvious choice, the one everyone recommends first, SCHD. It has over $70 billion in assets, making it one of the most popular dividend funds on the planet. People treat it like the answer to every retirement planning question. And honestly, for good reason. Companies need 10 consecutive years of dividend payments just to get in the door. Then it filters for fundamentals, cash flow to debt ratios, return on equity, dividend growth rates. The expense ratio sits at just 6 basis points. That's $6 per year for every $10,000 invested. Practically nothing. So what does Harry get if he drops $10,000 into SCHD right now? At a current yield of around 3.8%, that's about $380 annually. Paid quarterly, roughly $95 every 3 months, deposited straight into his brokerage account. Now, $380 won't change anyone's life. But here's what the raw yield number misses. SCHD has grown its dividend at over 10% annually for more than a decade. That $380 could become $418 next year, $460 the year after. Give it 20 years, and suddenly that same initial investment could be throwing off serious cash. Historically, from late 2014 through late 2020, $10,000 invested in SCHD would have grown to approximately $27,000 with dividends reinvested. Though future returns aren't guaranteed and past performance doesn't predict future results. Not explosive growth, but steady and reliable. But here's the thing, Harry doesn't want to wait. He's 53 years old. He wants income now, not income later. And $380 per year on $10,000 feels painfully slow when he's trying to build meaningful passive income before he stops working. So he looks at something different. JEPI. This ETF has exploded in popularity with over $40 billion in assets and growing fast. The reason is obvious. The yield, often between 7 and 8%, sometimes higher. On $10,000, that's $700 to $800 annually. Paid monthly, but amounts vary based on option premiums and market conditions. Some months might deliver more, some less, depending on volatility and the positions the fund holds. That's more than double what SCHD pays. Same $10,000, more than twice the income. How is that possible? JEPI uses a covered call strategy. It owns a basket of large cap stocks, names like Alphabet Inc., Johnson & Johnson, Amazon, and sells options on those positions. The premiums collected from selling those options get distributed as income. The expense ratio is higher at 35 basis points, $35 per year on $10,000. Still reasonable, but almost 6 times what SCHD charges. The real cost isn't the fee, it's the growth cap. When markets rip higher, JEPI won't fully participate. Those call options become obligations to sell shares at lower prices. So in a year when the S&P 500 gains 25%, JEPI might capture half of that. Maybe less. But for Harry, that might be fine. He's not chasing maximum growth. He wants cash flow stability, something that feels like a paycheck. JEPI's volatility is significantly lower than the broader market, which can help investors sleep better during downturns. 5-year total returns have averaged around 9 to 10% annually, surprisingly close to SCHD, despite the very different approach. Different path, similar destination. Still, Harry wonders, if 7% is good, what about 12%? Enter QYLD. This is where dividend income gets aggressive. The current yield sits around 12.5%. On $10,000, that's roughly $1,250 annually, over $100 every single month. Now we're talking real money. QYLD owns the NAS DAQ. 100 and writes at-the-money covered calls on the entire index every month. Tech stocks are volatile, and volatile stocks produce expensive options. That's how the income gets so high. But here's the trade-off. Over the past decade, QYLD has delivered roughly 8% annualized total returns. Not bad in isolation. But the NASDAQ 100 itself returned over 18% annually during that same period. QYLD captured less than half the gains, while distributing most of the option premium as income. In practical terms, QYLD isn't really paying you from portfolio growth. It's often converting future upside into current income. Some months, you may essentially be getting your own capital back, dressed up as yield. The expense ratio runs about 60 basis points, $60 per year, on $10,000, the highest of the three. Many investors see that 12% yield, invest $10,000, collect $100 monthly, and feel like geniuses. Meanwhile, their principal slowly erodes. 5 years later, they've collected thousands in dividends, but their position might be worth less than when they started. QYLD makes sense for one type of investor, someone who needs maximum current income, doesn't care about growing their nest egg, and understands they may be spending down their investment over time. Harry at 53 probably doesn't fit that profile. So let's put them side by side. $10,000 in SCHD, about $380 annually, quarterly payments, lowest yield but strongest dividend growth and capital appreciation potential. $10,000 in JEPI, roughly $800 annually, monthly payments that fluctuate, moderate yield, decent total returns, lower volatility. $10,000 in QYLD, about $1,250 annually. Monthly payments. Highest yield, but serious questions about long-term principal preservation. But what if Harry doesn't have to choose just one? A blended strategy? 30% SCHD, 50% JEPI, 20% QLL, on $10,000 could produce roughly $730 annually in dividend income. Monthly cash flow from JEPI and QLL combined could reach $60 to $70, though amounts will vary. SCHD provides growth and inflation protection. JEPI provides steady income with lower volatility. QYLD boosts cash flow on a controlled portion of the portfolio. That's not the lowest yield, not the flashiest yield, but it may be the smartest yield, because the number you see on a yield chart is never the full story. Sustainability matters. Tax treatment matters. Principal preservation matters. And most importantly, whether the income fits your timeline and goals matters more than anything else. Harry didn't need the highest yield. He needed the right yield. $10,000 can produce anywhere from $300 to over $1,000 in annual dividends depending on the path you choose. But the path that looks most impressive on paper often isn't the one that builds lasting financial independence. The strategies that compound quietly, reinvesting dividends, capturing capital appreciation, steadily growing payments year after year, those are the ones that can potentially transform modest starting points into life-changing outcomes. Whether you have $10,000 or $100,000, the math works the same. The real question isn't which ETF pays the most. The real question is, which approach lets you sleep at night while your money works for you?